thank you everyone for hopping on. Thank you, Amy. We have quite an audience here gathered and to talk energy and tax and the intersection of those two things. So let's get into it. So here's our agenda. Here's what we're going to be talking about. Build Back Better, very high level there. I'm going to hand it off to Kristen to talk 179D, some new kids on the block, tax-exempt entities, and then a really big one, energy efficient retrofit. So pay attention when Joe talks about that one. Then we'll go on to 45L. Will it be extended? How much will it be? Andrea will talk a little tax considerations, and I'll wrap it up with tax strategy. Okay, so besides me, you're going to be hearing from Joe Sawatsky, a principal in energy efficiency incentives, leads that group. You're also going to hear from Kristen Gustafson, and she's our director of 179D, and you may notice a lot of acronyms. You don't see these acronyms too often in the accounting world, so I'll run through them. PE, professional engineer, CEM, certified energy modeler, BEMP, building energy modeling professional under ASHRAE. ASHRAE is another acronym. She can tell you what that one is. And then LEAD, leadership in energy and environmental design. So happy to have her presenting today. And you also hear from Andrea Mao, partner in charge of our accounting methods and inventory group. All right. So Build Back Better, very high level. And it's not often you start a webinar talking about and promoting another webinar, but I think it's important. It's going to be a crazy week this week for the Biden presidency and for the BBB. And Mel and Jay, our guys on Capitol Hill, will be talking about that. So I recommend hopping on that to see how they're going to spend this $2 trillion-ish dollar amount. So we're going to be talking about, in a bubble, energy plus tax. In our world, better equals more efficient. We're going to be talking about efficiency deductions and credits that come out of the Clean Energy for America Act and the Green Act. And we'll hear more from Jay and Mel on Wednesday about the tax rates, but they're not going down, and we'll see if those things tick up. So it'll be a nice offset to have these deductions and credits offset any tax rates that might be going up. When will it be enacted? I've been listening to the Sunday Talk news shows, and it might be sooner than we think. It might be closer to that October 31st. I've also heard somewhere around Christmas, so we shall see. And who are the players? So we know Nancy and Chuck, Joe Manchin, Kristen, but take a note of these two gentlemen. Senator Ron Wyden of Oregon, the chairman of the Senate Finance Committee. House Representative Richard Neal of Massachusetts, also a chairman. And they are major players in the BBB, but also are major players in the Clean Energy for America Act and the Green Act, respectively. So we're feeling very optimistic that these things are going to get pushed through. And what are those things? So there was a proposed BBB. This is where you find all your energy stuff in subtitle G. You might recognize part 1, renewable electricity. That's what you're hearing in the news with Joe Manchin. He's pushing back on that a little bit. Part 3 is where we're going to focus today on. That's your energy efficient commercial buildings deduction, and then extending that 45L home credit. So let's get right into it. I'm going to hand it off right now to Kristen, who will talk about section 179D.
Thank you, Mark. All right, so I think I should have control. There we go, perfect. So what is 179D, as Mark mentioned? So as it currently stands, 179D is an energy efficiency tax deduction of up to $1.80 per square foot for qualifying properties. Energy models are used to claim the savings on HVAC, lighting, and envelope systems. Those mean walls, roofs, and windows against a baseline building, which is based on ASHRAE 90.1 standards. And Mark mentioned ASHRAE before. ASHRAE is the American Society of Heating, Refrigeration, and Air Conditioning Engineers. And I'm a member of that group, obviously. So there are two methods of claiming the deduction. The first one is for privately owned buildings. So these are buildings which are owned by an individual or a private entity which pays taxes. For these buildings, we can consider all properties placed in service after December 31st, 2005. This means they were constructed or renovated after that date. And then we use Form 3115 to claim the deduction on a current tax return. And then the second method is for governmental owned buildings. So these would be buildings owned by entities which don't pay tax in a traditional sense. This includes universities, school districts, state or local government buildings, things of that nature. So these entities can assign their deductions to quote unquote designers. This includes architects, engineers, contractors. Any of these folks can take the deduction on the behalf of the governmental entity. So for these projects, we can consider any building placed in service in an open tax year, which would be 2018 through the present. And then these deductions are obtained through amended tax returns. For both of these paths, a site visit is required to document the energy efficiency components of the building, and then the needed energy models are created to confirm the energy savings using a software approved by both the IRS and the Department of Energy. We found a better return on buildings larger in size than 25,000 square feet. This is not a requirement, but the return on investment tends to work out better for all parties. So let's look a little bit at how things are changing, how 179D stands today compared to what is being proposed in the new tax bill. So as we've mentioned, the current maximum deduction is $1.80 per square foot, split into those three categories of lighting, HVAC, and envelope. So each of these categories can provide partial deductions of 60 cents per square foot each, or contribute to those whole building energy savings, or that $1.80 per square foot. The building can take the deduction one time during its life. This deduction was introduced by the Energy Policy Act of 2005 and was recently made permanent by the Consolidated Appropriations Act. And as we mentioned, the deduction applies to both private building owners as well as designers of government buildings. So what's changing in the proposed bill on the right there? So firstly, the deduction amounts are increasing from 50 cents to $1 per square foot as a base, with bonus deductions available of $2.50 up to $5 a square foot across those three categories of lighting, HVAC, and envelope, using the whole building energy model. So those partial deductions are eliminated. A highlight to note is that the lifetime cap has been changed to a 3-year cap, and this is anticipated to take effect in 2022 and expire at the end of 2031. And it still applies to both private buildings and designers of governmental buildings, but now includes certain tax-exempt entities. So I'm going to talk a little more detail on these changes in the next few slides. Perfect. So I mentioned on the previous slide, the deduction rates are changing for this provision. In the pending legislation, there are 2 deduction rates available. The base rate is equal to 20% of the bonus rate, and the bonus rate is an increased rate for projects which meet certain prevailing wage and apprenticeship requirements. So the base starts at 50 cents per square foot for energy savings of 20% below baseline, and increases 2 cents for every percentage increase up to $1 per square foot at 50% below baseline energy usage. So for bonus rate, the deduction starts at $2.50 per square foot and increases 10 cents for each percentage improvement up to $5 per square foot. So increasing deductions, it's always it's a lot of things to consider here. So another highlight we're going to note is that the lifetime cap has been changed to a 3-year cap. This means that the building is eligible for the 179D deduction every 3 years, assuming that at least one of the systems contributing to energy efficiency has been renovated. So it's important to note that the deductions are capped at the cost of the property. So if you're installing new lighting in a portion of the building, the total deduction available would be capped at the total cost of that renovation. So another thing changing is the tax-exempt entities. So this proposal allows certain tax-exempt entities to allocate the deduction to the designers, those architects, engineers, and contractors who are primarily responsible for designing the property. So these tax-exempt entities include the federal government, any state or local government entities, and now includes any Indian tribal government and any tax-exempt organization, including not-for-profit hospitals. So I'm sure some of you on this call might have a few of these kinds of clients. Just know that designers might be knocking on their door looking for these deduction allocations, and they are going to need to have processes in place to administer the deduction. You may also have clients who do design or construction for these government entities, and it's important to consider how to advise them to benefit from this deduction. Another new item in this proposal is the new general business tax credit for qualifying mechanical installation labor costs. So this tax credit would be equal to 10% of the mechanical installation labor costs paid or incurred by the taxpayer during that taxable year. So mechanical installation labor costs includes the cost of installing the installation property, which means installation materials, facings, or accessory products for a depreciable mechanical system, which satisfies the energy loss reductions. So this credit is available for those labor costs incurred after December 31st, 2021 through December 31st, 2026. The last topic I'll cover on the commercial building side is Energy Star certification for buildings. So we've seen an increasing interest from our clients in certifying their buildings as energy efficient. Energy Star is run jointly by the EPA and the Department of Energy and is one of the most widely recognized symbols of energy efficiency by consumers. You're probably familiar with the label, seeing it on home goods and televisions and washing machines, things of that nature, but it also applies to buildings, and it's based on how much energy they consume compared to their peers. The Department of Energy has collected some data, which you see here, around Energy Star certified buildings. So while it's not a tax product in itself, there are tangible benefits to being Energy Star certified, including higher rental rates, higher occupancy rates for rented or leased properties, and then a premium on sales prices when the property goes to market. Additionally, landlords are intending to lease to federal tenants. They're required by the GSA to be Energy Star certified. And preferred financing is available to some of these properties, and particularly homes. So the benefit of doing Energy Star certification in conjunction with a 179D study is that a site visit is also required. So the needed data can be collected at the same time. So this is just an additional benefit to keep in mind. So at this point, I will be turning over to Joe. If you have any comments or questions, feel free to post them in the chat and I'll answer them as I can.
Fantastic. Thank you, Kristen. All right, take over here and I will be talking. I will dig a little more deeply into one provision that Kristen outlined in the pending legislation, something referred to as an energy efficient retrofit. And we're really excited about this program. We think there's going to be quite a bit of benefit for a number of our clients and others who could take advantage of this. And here you can see kind of a Venn diagram and what we'll be going over with this energy efficient retrofit. What this will do, it combines both the energy modeling and professional engineering that Kristen mentioned, and then it'll also blend in a couple items traditionally done by accounting firms, right? Specifically partial dispositions and qualified improvement property analysis. So the good news, and Mark mentioned it at the outset, maybe the rates will go up, maybe they won't. But the good news is if they do, these energy efficiency incentives should be able to ease that pain quite a little bit. So let's take a look here. Got carried away. All right, an energy efficient retrofit. So what that means is, let's take a step back. Kristen mentioned currently the 179 deduction, your building is judged against an ASHRAE 90.1 baseline. Depending on when the project was placed in service, that baseline might change. But if you think about kind of an older building stock, you know, where they, excuse me, may have quite a hurdle to get over that ASHRAE 90.1 baseline, the government, the Department of Energy and IRS would still like to incentivize those buildings to be retrofitted with the understanding that regardless of how efficient the lights are, based on the current property placed in service, there might not be an opportunity to get over that 50% savings threshold. So what this qualified retrofit plan is it compares the existing building to the proposed improvements. And the idea there is we're trying to demonstrate a 25% increase in energy savings over the existing bill. So it's not over the ASHRAE 90.1, but based on what's actually there in service at this potential time. So there you can see aggregate expected building energy efficiency of 25% more. And so it's an alternate and a parallel path to claim this deduction. So the highlights on the EER, as we're calling it, the building originally needs to have been placed in service in five years or prior, originally. So if you purchase a building placed in service 10 years ago, but you've only owned it for 1 year, you'd still be eligible to do the CER. Qualified individual that is a professional engineer or contractor licensed in the state of the property needs to certify both the energy consumption of the particular building as it sits today, as well as the energy efficiency after this retrofit has been in place. And again, we're looking for at least a 25% savings, for that base deduction, and then on a sliding scale could go up from there. And so the good news here, if you think about kind of a retrofit, let's take a look at an example. Let's take a look at a lighting retrofit example here. So, and here's where the accounting comes into play. So we're going to take a look at an EER for a lighting retrofit. You can see here some hypothetical information, although this data is anonymized. It represents a real world example. So in this case, you can see a building was originally placed in service in 2017. The lighting retrofit is planned to be in service January 1st, 2022. They're going to spend $250,000 renovating or relighting 150,000 square feet. And that represents a 90% of the existing lighting system is going to be replaced. So the good news here is, Kristen talked about the legislation, both currently and pending. The good news here is for projects moving forward, placed in service 2022, assuming the law comes online, there's going to be a great benefit there. But as we do tax planning for the 2021 tax year, we're able to take advantage of this EER under the current legislation, which is amazing. So here you can see a projected value proposition on the kind of the middle column there under current legislation and under the new legislation. There's quite a little bit to unpack here. So why don't I just kind of walk through each one of these rows. So under the current legislation, we see a benefit or a deduction of $705,000. Under the new enhanced legislation, possibly up to $995,000. So what is that? How do we come up with that 705 and 995? So the first thing we talked about, obviously, is the 179D deduction, right? You're able to, in the current legislation, base the deduction on the ASHRAE 90.1 standard. And if you're able to overcome that hurdle, then you have that depreciation or that deduction there. The second thing there is for the tax folks, something called qualified improvement property, right? So any interior non-structural renovation to an existing property qualify for QIP. And the current kind of tax picture, 100% bonus depreciation. I believe that steps down to 80% in future years. And then the third component there is partial dispositions of the existing property, right? So if we kind of think back to that Venn diagram that we saw earlier, there's kind of three tax to take. It's the 179D, the QIP, and the partials. And how do those three things kind of work together, right? Maybe there's basis for the 179D, or maybe it's kind of taken out by the QIP. And it's something, whether you work with Eide Bailly or your current firm, it's something that you kind of want to take a holistic approach at and say, all right, let's not just focus on the 179D, because there might be a more efficient way to get to the deduction through a qualified improvement property analysis. And how do we quantify the partial dispositions and the like? It's really need to take a holistic approach. So you can see under the current legislation, current year tax savings, federal tax savings, 209. Under the new legislation, that bumps up to 295. These are hypothetical study fees. Obviously, it's on a case-by-case basis, but we just kind of put an example in there just for your information. And then for the folks, I don't know if we have any lighting retrofit guys on the call. For folks on the call right now, kind of a net benefit summary for doing a project. right? And this doesn't take into account the energy efficiency savings, the energy savings. It doesn't take into account any of the maintenance savings of the new light, swapping out light bulbs, things of that nature. It's strictly under the tax code here. And so you can see the retrofit and study cost total under both current and pending legislation obviously is $280,000. First year tax savings, we can see from above there, 209 to 295, and then the net retrofit cost first year. Under the current legislation, it takes the cost of the retrofit, excuse me, from 250 down to 71. And then you can see this under the new legislation. It's almost unbelievable the way the math works. Is under this example, the retrofit would actually be better than free, meaning after you do all of the tax treatments, the appropriate tax treatments, and pay for the studies to have those tax treatments, there's actually a net benefit to the building owner in this case of $15,000. So said a different way or an easier way is, how would you like to have new lights and $15,000 of net benefit in the form of tax savings? So how do we get through, or how do we do all of these things? Let's take a look. And this is a little bit of small on my screen, but it's basically the three items that we kind of talked about, right? So we take a look at the 179D, and hopefully we can qualify for the full $1.80 and hopefully have benefit and basis there. We'll take a look at qualified improvement analysis, qualified property that qualifies for 100% bonus depreciation in this case. And then take a look at the partial dispositions, which will be recorded on form 4797. Number of the same steps to an EER study as is required as a 179D, right? So a site visit is required. Excuse me, certification of the project by a licensed individual, a licensed professional engineer, a license in the state of the property. And typically these things, depending on the scope and the size of the project, we're looking at, probably about 3 or 4 weeks from the site visit. All right. So I'll just give you guys a quick sneak peek here. Our Eide Bailly internal marketing folks are working through this. We'll have additional documentation on this EER coming out shortly. So for us Eide Bailly folks, you'll be able to find that in the Firm Resource Center here shortly. And then for folks who are external to Eide Bailly, feel free to reach out, and we're more than happy to give you that data when we have it all branded up. All right, so steps to a study, just at a very high level. The very first thing that we want to do, and this is assuming current legislation, because as we enter tax planning season today, obviously, what can we do today that'll help our clients, right? And then about this time next year, we'll have the new legislation, we'll do something similar. But what can we do today? So the first thing that we need to do is we need to collect the fixed asset schedule for the building and take a look at either the most current AIA or the renovation budget. And then a request for assessment form, which is a one-page form, biographical information about the building that we can also provide. Using that data, what we'll do is we'll create a benefit assessment. And for projects that are currently underway and expected to be placed in service under 2022, we'll create an assessment similar to the one that we saw at previous slides, where we have, all right, under pending legislation, it looks like it's probably going to have this benefit. Under the current legislation, it's going to have, this other benefit. And what I would recommend as you guys look at these projects is to kind of take the worst case scenario. In this case, it's under the pending legislation before we have the enhanced deductions available. And so hopefully the math works under both scenarios, and assuming it does, someone on Kristen's team or someone else on the fixed asset services team will schedule a kickoff call, kind of talk through the process, aggregate any additional information that we need. Then a site visit is required to, in this case, we're required to verify the energy efficiency components, as well as take a look at the QIP assessment analysis and make sure there's no loose ends that way. Then it goes through the energy modeling using the DOE and IRS approved software. Eide Bailly typically runs eQuest 365, but there are a handful of other approved softwares out there. And then once that's done, and in conjunction with that, it'll get kicked over to the Tangible Property Services teams, where they will do the QIP assessment, partial dispositions, and if there's any cost segregation opportunities there, if there's any additional basis that we can turn into an accelerated depreciation first year expense, they'll definitely do that. And then at the end of the day, delivery and implementation. On the 179D side, that actual deliverable, the important thing that you're looking for there is something called a certificate of compliance that's certified by, in this case, typically Kristen or someone on her team. There's 9 very specific pieces of information that's required by the IRS. The good news here is because these EER studies are done they're done in the year that the renovation is in place. There's no 3115 or 41A. So you just take that certificate of compliance and the associated report and kind of just keep that in your files in case anyone has any questions. And then the implementation directly into the fixed asset services software for the other components. Super. Now let's move on.
Before you go on here,
Thank you.
we have one question that we answered, but others on the call might want to hear that answer. And so it was talking about the retroactivity of the new legislation on 179D. And I'd say this, the $2.50 to $5 per square foot, that won't be necessarily retroactive. That'll start Jan 1, 2020 if it goes through. However, the $1.80 per square foot, that's you can go back to 2006 and that's permanent.
Yeah, that's a super point. Obviously, we'll see what actually comes through the legislation, but what we think is that that 250 to 5 will be as of 1/1/2022, and then anything going back to 2000 or January 1st, 2006 will fall under the old system and eligible for the full $1.80. The good news, and we think this legislation will come through in some way, shape, or form, but the good news here is, let's just say hypothetically this bill doesn't get passed or gets kicked down the road for, who knows how long. We still have permanency on the 179D deduction in its current form. So worst case, we're still looking at $1.80 per square foot moving forward. All right, let's take a quick look here. How are we doing on time? Perfect. Let's take a look at the Section 45L Energy Efficiency Home Tax Credit. And we'll do something similar to what we did with 179D and the EER. We'll talk about what our opportunities are today, and then take a look at what they might look like in the future. So 45L as it stands today, it's a $2,000 per qualifying unit credit for residential real estate, 3 stories or less above grade. So you think about garden style apartment complexes would qualify. And then obviously single family homes that are sold to an end home owner would also qualify. Now, dissimilar to cost segregation, 179D, and a lot of other fixed asset services, the 45L credit is not based on the date the project is placed in service, but rather it's based on the date that the unit is first occupied. So it is an example, if you had pick a number, 100-unit apartment building that was placed in service in late 2020, December 2020. It might be that one leases up 20 units in December in 2020, and the remaining 80 rather in 2021. And in that case, you would be able to take the associated credits for 2020, the 20 times 2,000, for your 2020 tax return, and the remaining, assuming they're leased up, in 2021. So it happens quite often where we will do studies here for an apartment complex, and we'll have kind of 2 sets of deliverables, one for 2020 and one for 2021, just depending on when either it was leased up or sold. Let's see, buildings or developments with 10 or more units are typically kind of more, kind of yield a better benefit because there is some kind of overhead or kind of some work that needs to be done, and we get the economies of scale, the more projects and the more units that we're looking at. And then we'll talk in a second here about a provisional analysis. So provisional analysis, provisional assessment. And so what this 45L is based on, it's based on the IECC, another acronym, International Energy Conservation Code. It's kind of a variation on the theme. Kristen mentioned ASHRAE before this. For the 45L, we're looking at the IECC. Now, currently, we're on the IECC 2006 standard. And so what we need to do is we need to demonstrate an energy efficiency of at least 50% or greater over that IECC. And of that 50%, 10% or 10% of the 50 or 20% overall needs to come from the building envelope. And because it's based on energy efficiency of the project in a specific location, obviously there are different targeted efficiencies depending on where your building is located, right? So I'm up in Minneapolis. The insulation and heating requirements are quite a bit different, and AC requirements are quite a bit different than a project placed in service in Scottsdale, Arizona. With that, so it's impossible to say definitively if a project will qualify before we actually do the work and do the modeling. But we have enough data now. We found some detriments to qualification, and there you can see a few bullets below. The big one, I'll actually start second to the bottom, is that 2x4 insulation on the exterior walls. That makes it extraordinarily difficult to be able to capture that envelope savings. Not to say that it's impossible, but it's really an uphill climb. Similar with the 100% electric resistance heating, they're just so inefficient. Even if we're in the kind of the warmer climate zones, it really makes it tough to get over that hurdle. And then AC units with SEER 13 or less is, gosh, I don't think you can even do that anymore, but we see it every once in a while. So what we typically like to do here at Eide-Bailly, if anyone's interested in exploring this 45L tax credit, the very first thing we like to do is we have this little utility that Kristen or myself or someone on our team can whip together with relative ease. Is we have a thing called the targeted efficiencies document. And there on my screen, again, it's a little bit low, but what this document does is it takes into consideration both the Energy Star standard that a particular state is in, as well as the climate zone of the existing building. And what you can see there in the targeted efficiencies is kind of the fact patterns that we'd like to see to give us a good indication that, yes, this project probably has a good chance of qualifying for the tax credit. At the end of the day, we're happy to do a provisional assessment on any project using the plans and specifications, specs specifically around mechanical, electrical, and plumbing. And we can say definitively whether the projects will qualify. But this is kind of just a good first glance. If we're way below on the SEER and EAR and for the AC down in Phoenix, it's not a great fact pattern. Similarly, if we're deficient in the heating systems and or exterior wall insulation up there in the northern climates, that's another fact pattern that is a little bit tough. And if it's a situation, just as an aside, if it's a situation where a project will not qualify based on the current standards, what we'll do is we'll create a non-qualification memo that outlines where the areas of deficiency are, and then opportunities to rectify, whether depending on where you're at in the project, whether for this project, gosh, if we can just bump up the R value in the walls by X, then we'll be able to qualify, or for projects moving forward, assuming we're on the same standard. So kind of the worst case is kind of an educational piece that we're more than happy to do for anyone who is interested. All right, so that's how it works today. Let's talk about a couple of the provisions that are proposed that we'll see. So as of today, the Section 45L tax credit is scheduled to expire on New Year's Eve of 2021. So this 45L is one of these extender packages where it's been around since the Energy Policy Act of 2005, and it has undergone, I think, 8 expirations and renewals in that time. But as it sits today, we are scheduled to expire at the end of the year. So there's a $1,000 credit for a manufacturing home and a manufactured home, and a $2,000 credit for both single family and multifamily projects. In the proposed bill, look, this will run through December 31st, 2031. So we've got a nice runway. When this goes through, a nice runway, and really actually allow people to plan and build in such a way where they're able to take advantage of these tax credits, as opposed to, gosh, hope that we did the right thing and we'll get it after the fact. And they kind of break it down into 2 tiers. So for single family and manufactured homes, they're going to bump the credit up to $2,500. That's kind of the base credit. And then there's a provision, assuming the home is a zero energy ready. It doesn't have to be zero energy, it just has to be ready for it. Then it bumps it up to a bonus credit of $5,000 per unit. Similarly, multifamily homes will yield a $500 per unit credit and $1,000 per unit credit, assuming we're zero energy ready under the Department of Energy Zero Energy Ready Home Program. So it's kind of a sliding scale. We saw in the climate maps and the Energy Star map earlier, a couple slides earlier. Any project placed in service for a single family will be subject to the DOE Energy Star Single Family New Homes Program 3.1 through 2023, and then after 2023 we'll be on 3.2. So right now there's probably, gosh, I want to say about half of the country is probably in a good spot to be able to be eligible for this credit, and then we'll just have to take it on a case by case on those states that are deficient. And then similarly, we've got the $5,000 per unit credit for the single family. Similar idea here. We see the excuse me, Energy Star Multifamily New Construction National Home Program, and you can see similar to above, the requirements will change as time goes on, but what doesn't change is the eligible unit will be eligible for $1,000 credit, assuming that the apartment building in this complex, or the apartment unit in this example, is Department of Energy Zero Ready. And so with that, if we have no questions, I'll turn it over to Andrea Mount to talk a little bit about some tax considerations.
Actually, Joe, we do have a question.
Oh, we do. Okay, great.
But it's a great segue to Andrea. I think it's a question for her, really. So Andrea, how would you like to start off your presentation with a question?
Why not?
Okay.
Go for it.
So this comes out in the proposed bill. Do the AMT limitations still apply for 45L?
To my knowledge, yes. I will admit I haven't gone through the details of a lot of the legislative language, but at this point I believe that they will, which is also an interesting segue to one of the other proposals that has been floating around. I'm sure you've heard a lot about, well, all these programs that the Biden administration wants to expand need funding. And so how are we going to fund all of these things? And one of the options that has been thrown out by the Biden administration and Congress in a slightly different manner is instituting a new base level tax, even on business income. It may operate similar to the way that the old corporate AMT tax works. One of Biden's proposals was a 15% tax on book income, not taxable income, but book income. And those of you who get in the weeds of some of the more complex tax returns realize that those two numbers are not necessarily in the same hemisphere sometimes. And so that's something we've also been watching, whether a provision like that would catch steam. And then, yeah, then that adds another level of complexity into the modeling exercise and trying to determine how best to move forward with this. But as of right now, I am not aware of any specific exception, but I've also been told by our legislative folks in Washington that as soon as they stop speaking, they could already be proven wrong. That's how quickly things are changing right now there. So stay tuned. And as Mark alluded to earlier, I think we're going to see a lot, hopefully, over the next few weeks that give us a little bit better idea of which direction Congress may be going in terms of where are we going to find these extra dollars that we need to support these programs. And on the tax side, as Joe and Kristen both mentioned, that typically these deductions or credits need to be claimed either in the year the building is placed in service for 179D or occupied for purposes of 45L. So what happens? I'm looking at my fixed asset schedule. I've got buildings from prior years that probably would qualify for the 179D deduction or the 45L credit. What do I do? Well, the answer is it depends, as any good tax answer is. It depends both on what type of taxpayer you are and what benefit you are looking to take advantage of. And in Kristen's discussion this morning, the 179D deduction effectively operates similar to the normal 179 deduction or bonus depreciation, where it accelerates the rate at which the building owner can recover the property. So it's a cash tax savings. We're accelerating deductions that we would otherwise be spreading over 39 years. And so in that context, where we're doing a 179D study for a building owner, the IRS has provided us with an automatic accounting method change procedure, which means that we can file a Form 3115. It is attached to a timely filed return, so we can attach that to a 2021 return. It can get attached to the return up to the extended due date, effectively. So you don't necessarily need to know by the end of 2021 if this is something you're going to want to take advantage of. We have until the return gets filed in the following year in order to determine whether it makes sense to move forward with the Form 3115. The nice thing about accounting method changes is that the IRS allows us to reach into closed years. So many of you are probably aware that typically you have 3 years after the date your return is filed to go back and amend and say, oops, I screwed up, paid too much tax, give me a refund. After that, the IRS can't come after you for unpaid tax, but you also can't pursue any prior overstatements of income or understatement of deductions. So what happens now if I have a building that's placed in service in 2017? Gosh, my 2017 statute's probably closed. Anything before that certainly is closed. Does that mean I lose that benefit? And the answer to that is no. You do not lose that benefit. We can reach into the closed years to pull forward what they call a 481A adjustment, which is a cumulative catch-up adjustment to claim all of the deduction that you otherwise would have been allowed to take had you claimed 179D in the year the building was placed in service. But that's also something to keep in mind, because when you look at a 179D deduction, you also have to reduce that by the depreciation you've claimed on that basis. So if Kristen's team does a study and says, hey, your 179D deduction is $100,000, but that property was placed in service, we'll say 4 years ago. Well, if it's 39-year property, that means roughly 10% of that $100,000 has already been recovered through depreciation. So we're going to offset her $100,000 deduction with the roughly $4,000 in depreciation. And so your net tax savings there is going to be $96,000 or so. So to me, I guess I do a lot of 3115. So to me, that's always the better answer, is to do a 3115. However, we can and need to file amended tax returns for some of these scenarios. So for example, as Kristen mentioned earlier, designers can take the 179D deduction on buildings that are owned by governmental entities and perhaps in the future, even other tax-exempt entities. Well, what happens if I'm a designer of a building that was placed in service in 2018 and I've now gotten the certification and I've been granted the credit from the building owner? I have to go back and amend that return. I don't have a building on my fixed asset schedule, which is why the IRS does not view this as an accounting method change. To be an accounting method change, we have to just be accelerating a deduction that I would otherwise be entitled to. So in this case, I don't have anything to depreciate, so I'm not going to be recovering those costs unless I claim the 179D deduction. And so in those circumstances, the IRS requires us to file an amended tax return. The same is true for 45L. 45L is technically a credit rather than a deduction, and there are no methodologies other than amended returns to go back and grab those credits. So the other downside here is, because again, we're talking about amended returns, we're stuck with 3 years. So looking back, it would be a return as of today that was filed on or before October 25th of 2018. That statute is now closed. So that's going to be most, calendar year 2017 returns and anything older than that. So we're unfortunately a bit limited in what we can take the deduction for in these situations. And now this is why I tend to get a bad reputation around of saying no to a lot of people, but this is something we need to be very careful about. I was on a panel a few months ago, I guess it's only been about a month now, with someone from the IRS who acknowledged that these issues, 179D, 45L, are becoming increasingly contentious between the IRS and taxpayers. So it's important when Kristen and Joe talk about what are the requirements for these, what are documentation requirements, all of those things are very, very important. If you have a service provider who isn't being clear with you about the risks or what your requirements are, I would recommend getting a second opinion. The IRS is challenging these. The LB&I, which is the Large Business and International Division, issued actually over the course of the last 2 years, they've issued 2 different audit statements on these topics, indicating to people, okay, these are to their examiners, this provides some educational background on what the issue is, what kind of questions they should ask, and what issues they should be looking at. Some of the more common issues that we have heard happening in the market are basis. As Kristen said, we are effectively accelerating the deduction of the basis of the energy efficient commercial building property. So in order to get a benefit there, and when we were talking about our 481A adjustment, I have to have some depreciable basis left in the asset that I'm looking to deduct under 179D. That is, in many cases, not an issue because most of these costs are going to be building costs that are being recovered over 39 years. However, due to some recent developments in the fixed asset space, the tangible property regs from 2014, the new QIP rules, we're finding that a lot of these costs, for example, in the lighting retrofit area, may have been already fully deducted by the client, either through it's a repair deduction if they're just replacing a few lights and they aren't upgrading it, or it could be QIP if there is an intentional upgrade of the property. And in those cases, the 179D deduction doesn't necessarily provide us with a lot of benefit there, not necessarily for the electrical system, but it may very well for the other 2 components. So don't walk away and think, oh, I don't care about this anymore. Just be aware that this might impact the amount of your potential benefit. One of the other things the IRS is being extremely insistent upon is who is required to do the site visit. As Kristen mentioned, the property needs to be certified as energy efficient. Someone needs to go on site, take pictures, and analyze, look at the building, and the IRS's opinion is that the individual doing that must be the professional engineer who's signing the report. So those of us who've worked perhaps in cost segregation and other areas in the past, those require site visits, but really anybody could have done it. So we could have had a CPA staff, we could have had someone from the fixed asset team who isn't a licensed engineer doing those site visits. And in the 179D space, the IRS is quite adamant that that is not acceptable. And anecdotally, we have not seen this issue come up on exam, but I have colleagues at other firms that have said that this has been a very significant issue with the IRS. And based on the comments of the IRS person on my panel a month ago, I can tell you she firmly believes that this is a requirement. And even if I don't necessarily agree with her, I'm afraid we're going to have a very difficult time changing her mind if she were to catch this. The other issue is in the designer area. So not the building owner, but this is being allocated to the designer who's eligible to be a designer. In the notice, the previously issued IRS guidance, it mentions some examples: engineers, architects, general contractors, certain contractors, but not people who are strictly providing installation or repair and maintenance type services. So obviously there's quite a bit of real estate between those 2 areas, and where in that spectrum, where's the line? And the IRS has said it's an activities-based analysis. So you can't just be a person who is strictly a service provider. You need to provide technical services, not just installation, not just cleaning, not just recommendations. There needs to be an element of technical analysis in the services you're providing. They haven't given us, there's no nice bright line here. All we know is architects and engineers, probably always okay. Contractors just doing installation, probably not okay. But in the middle there, we need to make sure we're understanding what services are being provided, how technical are those, what is the nature of those services, to make sure that the person claiming the deduction is eligible for the benefit there. And I think I'm going to kick it back to Mark now to wrap up.
Yeah, thank you, Andrea. And we have time to wrap up here, a good 7 minutes. So I'm going to take back control. So what you've heard from Kristen and Joe and now Andrea is that Venn diagram that Joe showed, right? This is not just an energy thing. It's not just a tax thing. It's really coming together of these two subsets into one. So how do you plan for something like that? What's the strategy? So I'm going to give some tips that I've seen that we've used with our clients and things I've seen taxpayers do in this space. So on the planning for energy plus tax, it starts with this discovery conversation. You heard it already a couple times, but things are changing. This week is going to be a big week, maybe the week after, where they're really going to increase the materiality of these things. So tax departments have to step back and review and rethink was once something maybe immaterial in 2006 is now something that you really got to pay attention to. And then a second thing there is owners and tax departments and whoever's dealing with these things need to consider energy efficient elements into their retrofits. So Joe talked about energy efficient retrofit. That's a new term that came out of the proposed legislation. We anticipate that it will be in the final as well. And really that one is everyone's entered into the club. So if you couldn't quite get there with 179D or 45L as they are traditionally, maybe is your way in to be retrofitted and get those deductions. But you got to be proactive. You got to get that qualified letter at the beginning in the design phase for the energy efficient retrofit 2022 and beyond. Or as Joe said, you can go back and try to grab as much stuff retroactively. So something to think about. Staying educated, of course, during the discovery, we've already talked with a lot of our clients about these things. And as milestones hit, as legislation hits, we'll continue to have webinars and have these discovery calls. Just stay educated, get up in front of this, besides being reactive. And we see a lot of reactive and some other depreciation incentives. But when it comes to energy, proactive is the way to go. And so after this discovery and your planning, you get into this, our clients get into this provisional assessment where you start putting some stuff on paper. You start measuring. And again, the materiality, the $1.80 didn't do it for you before, $5 will. If the $2,000 credit per unit didn't do it for you before, maybe the $5,000 per unit credit will too. So these start being measured, kind of part of your process. That's where the collaborating comes in. So you got this energy and this tax, and sometimes these things get siloed, and more often than not, they're on the tax teams. And really, if you want to be successful in gathering this information, gathering this data, and spitting out good deductions and good credits, bring in the accountant as soon as possible, bring in the real estate people, construction people, and even the energy departments. And I know that we have some on the call that you're all 5 of those things, or 4 of those things. And some on the call, I have legions of people in each one of those departments, but the collaboration is really important there. Then during the provisional assessment, to break it down really easy, it's marrying together your real estate portfolio with your fixed asset ledger. So again, your energy building items in your portfolio, and your fixed asset ledger tax, and seeing where those two things come together. So that's the planning. Now, strategy. So you take the results of your provisional analysis, you start to dashboard 179D past, present, and future. You're from Andrew, we can catch up the deduction, the $1.80. We can catch up the 2,000 per unit on an amended level. And so it's starting to dashboard. Okay, what do I got hidden in the past? What do I got in this year, 2021? How can I plan for the future? And you dashboard that for the 179D, for the 45L. And then you get this energy efficient retrofit, which is brand new. You got to start considering that too. And again, it can't be overstated. The collaboration when you're dashboarding has to come across from accounting, real estate, construction, energy departments, or of one mind, whatever that is for your company. And then the fun stuff starts to happen. You start to pull the levers, and you answer the questions, and you answer this, usually with your accountant every year. What are your tax goals? What deductions or credits do you need? You start getting this into your capital expenditure request or your authorization for expenditure, whatever you do to get capital into your building. And how do you implement that so that it can spread through to the tax team and onto the depreciation software seamlessly? And then when you're pulling levers, flexibility is the name of the game, really, just like in other depreciation provisions. Analysis can be run by building. It can be run retroactively. And that together gives you scenarios and options in any given tax year and where you're at. So to sum up, you have to have the discovery call. This starts in November. We're already doing it for our clients. We're going to be, and if you are a client and we haven't had the discovery call yet, it's happened. It's going to happen in November. It's going to happen in December. We get that real estate portfolio, see how it jives with energy efficient incentives. And then we'll run the diagnostic, shine some light on anything that's been hidden and anything proactively, take the results of that assessment, we'll dashboard. And that's where the fun really starts. Like I said, you start to make some strategic decisions in any given tax year, what levers you're going to pull. And those levers can come in the form of, let's retroactively catch ourselves up. So by 2022, we're ready for these things. Or let's do a proof of concept and do one really big building in our portfolio to get that process and that collaboration through from the accounting department to the construction real estate team all the way through. And then even from a lever of, let's go in 2022 and get this into our capital expenditure request system. So we're just getting the deductions as they come in and putting them onto the tax return. So hopefully you stayed with us through all those details. Quite a fire hose. There's going to be more to come. Like I said, it's going to be an interesting week. Hop on for Jay and Mel on Wednesday. Maybe we have some good news around BBB, at least in the energy side of things. We're going to keep you guys educated as we learn more and start to play with our tools and models. Well, looking forward to hearing it from everybody. Start those discovery calls. Anyone here, Mark, Joe, Kristen, Andrea, can get those kicked off for you. And more to come. I promise you that.